Hi, this is Josh Weidman with Bird Dog Investor and Hard Money Bankers. People ask me all the time, what's the first step once I've gotten that property under contract? Where do I go from now? From there, what am I doing now? It's a question that a lot of seasoned investors kind of forget about, and certainly a lot of the people that are selling products and doing trainings, it's a key factor that a lot of times they forget to bring up. When you go into a project or you go into a house, you should always have an idea of your end game. What's your exit strategy on the property? I spend an awful lot of time in Bird Dog Investor and with our trainings at Hard Money Bankers talking about marketing, and then once the leads come in, what to do with those leads, how to screen them, how to negotiate with sellers, and ultimately how to put a property under contract. But once that's done, the next step is to move forward and start making the money. There's a couple options that you have. First option is wholesaling. I'm a big proponent of wholesaling for a couple reasons. Number one, there's very little risk. Number two, you can make a good amount of money wholesaling deals in a very short period of time. And number three, you never have to own the property. You never have to take on the liability. And at the end of the day, it's a really good option for a lot of people. One of the setbacks to wholesaling is that you're leaving a lot of money in the deal. If I didn't mention this before, wholesaling it's a process of putting a property under contract, and you're going to sell that contract to an end buyer. Many times this end buyer will be purchasing the property either to fix it up and resell it themselves, or to fix it up and put a tenant in there, or buy it as an investment property of their own. So it's important that you leave money in there in the deal for the end investor. Otherwise, you're not going to be able to sell them the contract. So you're leaving money on the table with a wholesale deal, but it is a faster transaction, and there's very little liability. The second option is to rehab. Rehabbing is the process of purchasing a house, fixing it up, and reselling on the retail market. Obviously, the goal is to make a profit. The benefits of rehabbing a property are that you're going to be making much more money. Instead of making $5,000, $10,000, or $15,000 on a deal, you're looking at $25,000, $50,000, or even $100,000 on a transaction. And last month I had a student that called me leaving the closing table with a check for over $108,000. Will was pretty happy, and there's like I said, a lot of benefits to rehabbing. The negatives with a rehabber is that first, you need access to money or have your own money. Second, you need to know the construction market. You need to know how to manage a project. And third, there's a lot more liability. If you're owning the property and the market changes, you could be in trouble. If you own the property and it burns down, you could be in trouble. There's more liability involved, thus the profit margins are higher. The third option is the JV on a project. JV stands for joint venture. A lot of investors choose this option when they are dealing with they're in a position where maybe they have a great property, they can wait for the money on a resale, but maybe they don't have the money. Maybe they don't have quite the experience that they need to manage the construction on the property. So they're going to bring in a more experienced investor or an investor with money, and that's somebody with a vested interest in the property to look out for the project. That maybe they know the construction industry, they know how to find contractors and manage a project, or maybe they have the money and they're going to look out, make sure that you're not stepping in holes that they've seen before. So joint venturing is a good option if you can hold off and you can wait for the money for the resale of the property to get paid. It's not quite as much money as a rehab deal because you're going to be splitting the profits with your joint venture partner. The last option that we have here is the buy and hold option. Now, a lot of investors, when they're first getting started, they think about building a rental portfolio. It's not something that I recommend from the very beginning if you're new to investing. These other three options are great to generate a good amount of cash flow immediately. The buy and hold option is a very good strategy if you're looking to, like I said, build that rental portfolio. You're looking for really long-term wealth and you're looking to maybe set up a retirement vehicle or put away an investment for your kids' education. But these are the 4 exit strategies. I encourage anybody that is getting into a deal to think about this before they're going to look at a property, because at the end of the day, you want to know what your exit strategy is before you walk in the house and you make your offer. But I wish you your best in investing, and we'll see you soon.